McIntyre, the elder law guy here at McIntyre Elder Law. And thank you, Rob. Robert Ashford is our cameraman today, so he's going to move around a little bit and kind of help show you what we're doing. This is our Saving the Farm book series. I'm on chapter 8. Okay, we skipped a couple of weeks, but we, just because of vacations and things, we wanted to come back and finish this up. There's 10 chapters. This is chapter 8. Estate taxes, to plan or not to plan. There is no question, okay? So we're going to go over estate tax a little bit today. It's very interesting how estate tax works with gift tax now. And in chapter 8, we tackle a little bit of that subject, okay? At the time I wrote this in 2015, the estate tax was $5.43 million, estate and gift tax. So we start talking about just what estate tax is, and that the current estate tax rate at that time was 5.43. It's at 5.45 right now per individual. And we talk about estate tax through history. That means, okay, by the way, with it being at 5.45, that means that unless you have over $5.45 million, then there will not be a federal estate tax on your estate, okay? There could be some kind of state levy or state, fees, but not federal estate tax under estates up to $5.45 million. This could concern estate planning attorneys who are used to drafting a lot of trust. And, before the last probably 6-7 years, a lot more trusts were drafted for tax avoidance purposes. The reason, and the real question is, when you plan, should you have one eye on the estate tax? And my answer is yes, you should. And you should think about that. You know why? Well, there's a section, the second subsection of the chapter is estate tax throughout history. And we talk about an IRS document entitled The Estate Tax, 90 Years and Counting, okay? And we reference that document at the bottom of that page, on page 142. And Rob, if you want to get a shot of this, there's a great document, The Estate Tax, 90 Years and Counting, and I'm sure it's going to hold your attention like it did mine, IRS document. It's a PDF that you can download. I would just Google it, Estate Tax Chart, IRS. I think I just put in estate tax chart. And it starts walking you through the history of the estate tax up to the modern estate tax. And with significant, it gives you a timeline of significant estate tax changes. And look, there were changes, big changes, 1916 when it was enacted, 1918, 1924. The gift tax was repealed in 1926. Gift tax reintroduced in 1932, 6 years later. Alternate valuation in 1935, and so on and so forth. So many different changes, okay? Up to current, up through 2001 is where it looks like they stop with that chart. And so on and so forth. It's a very interesting document that, if you read it, tells you one thing. And the one thing is, if there's any constant in life, it's change. And the constant with estate tax and gift tax is that it changes. It changes and fluctuates throughout history with the needs of the country, with current political environments, with the party that's in power, with the philosophy of that party, because those philosophies switch sometimes between parties. It just depends on the flavor of the era and what the needs are. So in order to, but you don't want change when you're doing estate planning. You want to know that you're relying on solid law and solid ground when you're planning. But I promise you that there will be change in the estate tax. There will be change in gift tax. The reason I mention gift tax is the estate and gift tax now work together. So if you have a $5 million deduction as of 2016, and I give Rob's our cameraman. Rob, I'm going to give you $1 million. Okay.
Ooh.
Okay. Will you hand me that? How about this? I'll get it. Okay. I got to get some Monopoly money. This is my trust. This is my trust. Let's pull some money out. You know what, Rob? This is my fortune right here. Okay. I'm going to give you $1 million. Okay. And I know that during life, with the gift tax, I can give you $5.45 million tax-free. Thank you, Robbie Reynolds, by the way, for explaining this in detail to me quite a few years back so that it hammered it into my head exactly how it works. I can't tell you how many people I've gone through well, it's $10,000, it's $14,000, I'm not sure. It allows me to explain it very quickly and easily. Robbie's an accountant here in Shelby, North Carolina. So $1 million goes to you, Rob, okay? I'm gifting that to you. Rob, do you have to pay any tax, or do I have to pay any tax on that gift?
No.
That's correct. No tax whatsoever. But, you know, I'm holding some more money in my hand, okay? And let's say I leave this to you in my will, or when I die, okay? When I die in my will. So I'm going to leave you, let's say this is $10 million, Rob, okay? This is $10 million of my Monopoly money right there. I played hard for this, all right? And I'm going to pass this along. Can I give this whole $10 million to you tax-free when I die?
No.
How much can I give you? I've already given you $1 million during my life.
4.4.
$4.45 million is how much I can give you tax-free when I die, because they work together. Where that $10,000 wrinkle comes in, or $14,000 wrinkle that you, or the real common conception out there, or misconception about tax and gift tax, is it used to be 10. That's what you heard. Oh, I can give $10,000 tax-free, or I can give, now it's $14,000 tax-free. What that means is, and I'm not a tax attorney, by the way, but I have to know about tax as it relates to estate and gift tax, okay, to be able to plan accordingly with my clients. So if I give $14,000, I could give that to everybody in this town, to everybody on the block, okay? So I could give some over here, some over here, some over here, some over here, some over here. You know, I'm going to give it to my uncle. I'm going to give it to my cousin. I'm going to give it to the guy down the street. I'm going to give it to my landlord because I like my landlord. I'm going to give it over here, okay? And, you know, I've spent out a good amount of money there, a bunch of $14,000 gifts. Do I have to report that gift to the IRS? The answer is no. I don't have to report that gift. That's a non-reportable gift, okay? That just means it doesn't count off on my $5.45 million exemption that I can give during life with gift tax, or in death with estate tax. So it doesn't factor in or count off how much I can give away tax-free, okay? That's the only thing that $14,000 means. So if I give away $5.45 million according to current tax laws during life, the whole thing, then in death, if I give away, let's say I keep more money, that's going to be taxable under estate tax, okay? So some of you may say, hey, it's $5.45 million. What do I care? I don't have that. I'm never going to have that. I hope you will. I hope you win the lottery, or that your ventures pay off. How about that? But, you know, I go back to the constant, and that's change. Of course you should plan for it, because I don't know next year if it's going to drop to $1 million. I don't know if it's going to drop to $500,000. I don't know if all of a sudden there's a crunch and a squeeze with everything that's going on with the world and China and who we owe money to, and current tax rates and current money that is owed, or current needs of the country. I just don't know what's going to happen, and they might set it at $250,000. I just don't know. So instruments like trust, for instance, allow you to split estates and values into separate trusts and credit shelter trusts, things like that, to avoid taxation if there's a taxable event going to occur. So your trust should be programmed and drafted to be flexible and avoid taxation just by the way they're drafted if a taxable event occurs when you pass away, so that you avoid giving away a large chunk of this money to the state or the government when you pass away. So you should plan for estate tax and gift tax. I hope this has been a good refresher to show you how that works. We talk about that within Chapter 8 of Saving the Farm. To plan or not to plan, there is no question. And we talk about some different strategies, okay, to avoid estate and gift tax, okay? Hopefully this wasn't too dry a chapter, but it's a necessary chapter that you need to consider when you're drawing up your estate plan, okay? And it's also a reason that trusts are still great ways to plan if you have an adequate asset level, okay? Just to make sure that you're not going to get hit with an estate tax that's going to take a big chunk of what you want to leave to your children or grandchildren or other descendants. Thank you very much. If you want to check out Saving the Farm as a whole, there's a ton of great advice. I spent about 2.5 years researching the contents of this book. You can go to mcelderlaw.com/savingthefarm. Saving the farm is a metaphor for your hard-earned money and property, okay? But it's an actual story involving one of my family members that kicks off chapter 1, okay? So go to mcelderlaw.com/savingthefarm, or you can go to Amazon, iTunes, Audible. The audiobooks, amazing, narrated by Curtis Rosser. His voice is like butter, okay? Tune in next week where we'll do chapter 9, okay? And chapter 9 is Choose Wisely, Grasshopper, selecting the right attorney and firm when picking an estate planning and elder law attorney. Thank you so much for your attention and have a great day.